All right, welcome. Today we are going to crack open one of the most powerful, and let's be honest, sometimes one of the most intimidating tools inside of NetSuite, Advanced Revenue Management, or as you'll hear it called, ARM. We're going to demystify it and break it all down.
So let's start with the core problem that ARM was actually built to solve. Imagine your company sells a big bundle deal. It's got a software license, a full year of maintenance, and maybe some professional services thrown in. You get one single payment, but the value you're delivering, that happens over completely different timelines. So the big question is, how on earth do you account for that revenue correctly?
And that right there is where ARM comes into the picture. It is NetSuite's automated answer to that giant puzzle. It's specifically designed to handle these really complex contracts, making sure your books stay compliant with modern accounting standards, all without you having to do a mountain of manual work.
So here's how we're going to tackle this. First, we'll really dig into the puzzle itself. Then we'll look at how you lay the groundwork in the system. After that, we'll see how a regular sale transforms into a revenue plan, watch the automation really kick in, and finally we'll look at the reporting that ties it all together.
Okay, let's get right into it. The real challenge here isn't just about spreading revenue over time. The tricky part is that when you sell a bunch of things together in one bundle, the price you stick on each item on the sales order, well, it might not actually reflect its true standalone value.
And this, right here, is the absolute heart of the matter. You can't just go by the prices on the invoice. Modern accounting standards demand that you take the total cash you received and allocate it across every single piece of that bundle based on its fair market value. This is the allocation problem that ARM is built to solve.
Now, before ARM can work all its magic, you have to teach it the rules of the game. This whole initial setup is about building the logic, the rule book, that the system is going to use to automate every single transaction from that point forward. And really, it all boils down to three key things. First, you have to switch the feature on. And I have to warn you, this is a one-way street. Once it's on for good. Next, you define all your revenue rules. And finally, and this is probably the most critical step of all, you configure your items.
And look, the documentation could not be clearer about this. Getting that item configuration right is the absolute bedrock of the entire system. This is where you tell NetSuite exactly how every single product or service needs to be treated from a revenue perspective. You have to get this right.
Okay, so you've put all the rules in place. Now let's see how this actually works. When a sale gets approved, NetSuite does something really interesting. It doesn't just create an invoice, it generates this special parallel record, just for managing the revenue side of that contract.
And this thing is called a revenue arrangement. The best way to think of it is as the master blueprint for all the revenue on that contract. It's a non-posting transaction, which just means it doesn't hit your general ledger directly. Instead, it's the command center where all the complex revenue calculations and allocations actually happen. So, to make all these adjustments, ARM uses two really key ideas: carve out and carve in. A carve out is what happens when an item's sales price is more than its fair value allocation. And you guessed it, a carve in is the exact opposite. That's when the sales price is less than what it should be.
And here's a perfect example of how it all balances out. So the system takes that total deal value, $12,000, and it starts redistributing it. It carves out $800 from the license and carves it into the maintenance, all to make sure everything lines up with its fair value. And notice the key part. The total revenue is still $12,000. It's a perfect zero-sum game.
Okay, so the blueprint is set. The plan is perfect. Now it's time to fire up the engine. This is the part where ARM takes that perfectly allocated arrangement and just starts doing the work, scheduling and posting the actual revenue over time all on its own.
And this automation flow is just so logical when you see it laid out. First, the sale happens. Then the arrangement gets created. From that arrangement, the system generates revenue plans, and these plans are basically just the schedules that tell the system exactly when to post the journal entries that move money from your deferred revenue account into your actual recognized revenue.
It's also really interesting that ARM creates two different kinds of plans. You've got actual plans, those are the real deal, the ones that actually post to your general ledger. But it also creates forecast plans, and these are brilliant because they're used for reporting, so you can see your future revenue streams without messing with your live books. Super useful for financial planning.
And this brings us right to the finish line, the month-end process. This is where everything comes together. You finalize the numbers for the period, you reconcile your accounts, and you generate the reports that prove everything is accurate, compliant, and ready to go. Now listen up, because the order of operations here is absolutely critical. First, you run the process that generates all the revenue journal entries for the month. Then, and only then, do you run the deferred revenue reclassification. If you follow this exact order, your financials will be accurate every single time.
And the ultimate prize for all this work is the Deferred Revenue Waterfall Report. I mean, this is your key reconciliation tool. It shows you exactly how your deferred revenue moved from the beginning to the end of the period, and it gives you a forecast of your future revenue streams. It is an incredibly powerful report.
So, let's just end with this thought. As more and more companies move away from simple one-time sales and into subscriptions or complex bundles, just how critical does a system like ARM become? It really feels like it's not just about compliance anymore, it's about having the automated financial backbone to actually support growth in this modern economy.